Welcome to Cash to Capital, where we turn idle savings into a strategy for long-term wealth. In this video, we will walk through 3 essential pillars that move you from a static bank balance to a proactive plan: building a safety net, establishing credit, and investing for growth. To ensure you can act immediately, we will also include a practical 30-day action plan, diagrams, examples, and quick quizzes. Let's begin by setting the stage for why this matters now. First, here is why this topic matters now. If you have meaningful cash savings and low debt, you are in a strong starting position. However, leaving too much cash in low-yield accounts lets inflation quietly reduce your purchasing power. By shifting from passive saving to structured actions, you can protect your downside, lower borrowing costs, and capture long-term market growth. Next, let's preview what we will cover. Here is the roadmap. We will start with the safety net, built via a high-yield savings account. Then we will establish a responsible credit framework that lowers your future borrowing costs. After that, we will turn to retirement accounts and index funds that drive long-term growth. To make this actionable, we will provide a 30-day implementation plan. Along the way, we will use diagrams, examples, and short quizzes. Before we jump in, let's quickly note an important disclaimer. Before proceeding, please note that this video is for educational purposes only and does not constitute financial, tax, or legal advice. All investments involve risk, including potential loss of principal. Interest rates, account features, and tax rules change over time and vary by country. Always verify current details with your providers and consider speaking with a licensed professional who understands your personal circumstances. With that covered, let's explore the core framework. To set the framework, visualize your cash branching into 3 paths. First, carve out 3 to 6 months of living expenses in a high-yield savings account. This serves as your liquidity buffer so you never need to sell investments at a bad time. Second, build a strong credit profile by using 1 or 2 credit cards responsibly and paying statements in full each month. This improves your score and lowers borrowing costs. Third, focus on long-term compounding by contributing to retirement accounts, prioritizing any employer match, and low-cost broad market index funds. Now, let's dive deeper into each pillar, beginning with your safety net. First, establish an emergency buffer in a high-yield savings account. Your target is 3 to 6 months of essential expenses, not luxuries. The primary purpose is liquidity and stability, so this is not meant for high returns. Keep it risk-averse and accessible. Choose an account with competitive yields, ideally FDIC or NCUA insured. To make progress consistently, automate transfers on each payday. Avoid the temptation to invest your emergency fund. It must remain stable so you are not forced to sell investments if an unexpected expense arises. With the safety net set, let's transition to building your credit foundation. Next, build your credit foundation. If you lack a credit history, open 1 or 2 starter credit cards and use them like debit cards. Keep utilization low, ideally under 10% of your limit. Always pay your statements in full and on time. Autopay helps ensure this. Keep your oldest accounts open to increase your average account age. Rewards can be valuable, but only if you avoid interest. Monitor your credit scores and reports periodically to catch errors and track progress. With credit in place, we can now harness tax-advantaged retirement accounts for growth. Finally, focus on long-term growth through retirement accounts. If your employer offers a 401k match, contribute at least enough to capture the full match because it is effectively a guaranteed return. Next, open an IRA, choosing between Roth and traditional based on your current and expected future tax situation. Within these accounts, select low-cost, broad market index funds, which historically have beaten most active managers over long periods and comfortably outpace inflation. Automate contributions and allow compounding to work over decades. Rebalance periodically and avoid reacting emotionally during market volatility. To clarify the IRA choice, let's compare Roth and traditional side by side. Here is a quick comparison. For a Roth IRA, you contribute after-tax dollars, and qualified withdrawals in retirement are tax-free. A Roth can be advantageous if you believe your tax rate will be higher in retirement. Roth IRAs have income limits for direct contributions and do not require minimum distributions for the original owner. For a traditional IRA, contributions may be deductible depending on income and workplace coverage, and withdrawals in retirement are taxed as ordinary income. A traditional IRA can be beneficial if you expect a lower tax rate in retirement. Non-deductible contributions are permitted and Required minimum distributions apply. With the choice framework clear, let's quantify your emergency fund target. This table shows how to set your HYSA target based on your monthly essentials. Multiply your monthly essential expenses by 3 to get a minimum buffer, and by 6 for a more conservative target. For example, at $2,000 per month, a 3-month fund is $6,000, and a 6-month fund is $12,000. Use your real essential expenses to personalize these targets. Now, to ensure you can implement all of this quickly, let's outline a 30-day action plan. To operationalize this, follow a simple month-long schedule. In week 1, open a high-yield savings account, calculate your 3 to 6 month target, and set an automatic transfer from checking each payday. In week 2, open 1 or 2 credit cards, enable auto pay in full, and route small recurring bills through them to demonstrate consistent use. In week 3, enroll in your employer 401k and contribute at least enough to get the full match. Also, open an IRA at a low-cost provider. In week 4, select broad market index funds, automate monthly contributions to both accounts, and schedule a quarterly calendar reminder to review your progress. With a plan in hand, let's quickly explore the math behind compounding. Here's a quick look at compounding. The general future value formula for a single lump sum is A equals P times 1 plus R to the N. In the example, we start with $10,000, add $500 per month, and assume a 7% annual return over 20 years. The simplified math shows how both the initial amount and the ongoing contributions grow over time. The exact outcome will vary, but the key insight is that consistent contributions and time in the market are the primary drivers of long-term growth. With the concept in mind, let's test your understanding with a quick quiz. Question: what is the primary purpose of a high-yield savings account in your plan? Options: A, to chase high returns and outperform the stock market. B, to hold your emergency fund for liquidity and stability. C, to replace the need for credit cards. D, to avoid paying taxes forever. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The high-yield savings account is primarily for liquidity and stability. It is not for chasing high returns, and it does not replace the function of credit or taxes. This buffer protects you from needing to liquidate investments at an inopportune time. Question: what is the most effective way to build credit using credit cards? Options: A, max out your limit and make minimum payments. B, use the card for essentials and pay in full every month. C, open many cards at once to increase your limit. D, never use credit cards at all. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Using your card for essential expenses and paying in full and on time each month builds a positive payment history and keeps utilization low, which are major drivers of a strong credit score. Avoid maxing out, opening too many cards at once, or avoiding credit entirely if you aim to build credit. This sequence diagram illustrates the monthly flow of funds. You receive a paycheck that first routes through payroll deductions, such as employer 401k contributions. The remainder lands in checking. From checking, automated transfers move a set amount to the HYSA until the target is reached. A scheduled contribution goes to the IRA, which then invests in broad index funds. Separately, your credit card autopay in full draws from checking to cover essential spending while keeping utilization low. The remaining balance covers bills and discretionary categories. This flow ensures consistency and reduces the need for manual decisions each month. This pie chart depicts an example starter budget. 10% goes to topping up the HYSA until your target is reached. Another 10% goes to the 401k, particularly to capture the full match, and 10% to the IRA. 50% covers essentials like housing, utilities, and groceries. 18% is discretionary, and 2% is allocated to giving or charity. These percentages are illustrative and should be adjusted based on your income, expenses, and stage of saving. This mind map organizes the strategy into 4 branches. The safety net branch highlights building 3 to 6 months of expenses in an insured high-yield savings account with automatic transfers. The credit branch emphasizes opening 1 or 2 cards, paying in full, keeping utilization under 10%, and monitoring reports. The growth branch covers capturing the 401k match, choosing between Roth or traditional IRAs, investing in index funds, rebalancing, and automating contributions. The habits branch includes setting reminders, conducting quarterly reviews, and increasing contributions annually. Together, these branches depict a holistic, repeatable system. Here are several practical tips to maintain momentum. Automate as much as possible, from transfers to contributions and credit card autopay. Increase your savings rate when you receive a raise, or at least once per year. Keep investment fees low, and avoid trying to time the market. Prioritize capturing the employer match in your 401k before allocating additional funds to your IRA. Finally, revisit your HYSA target when your life circumstances change, or after significant expenses to ensure your safety net remains appropriate. Now, let's wrap up with the core takeaways and your next step. To summarize, safeguard your downside with a 3 to 6 month HYSA buffer. Build a strong credit profile by paying in full and on time with low utilization. Capture your employer 401k match, then contribute to an IRA and invest in low-cost broad index funds for long-term compounding. Automate contributions and schedule periodic reviews to stay consistent. Most importantly, start now because time in the market is your greatest asset. Finally, here is a quick thank you and a call to action. Thank you for watching. If this was helpful, please like the video, share it with someone who needs a plan, and subscribe for more clear, actionable finance content. In the comments, tell us the first step you are taking this week and any questions you want covered next.